Hope everyone's doing well and had a good trading day today. This is the Emini review for Thursday, June 27th, 2024, and I'm just drawing the prior day's high and low. Always important, magnets, support, and resistance. And because tomorrow's Friday, so tomorrow's the end of the week, and it's also the last day of the last trading day of the month of June. So we'll look at the monthly chart first. As you can see here, we're getting a bull breakout on the monthly chart. And let's look to the left. Here's a swing high. So we had a bull trend line break, and then a retest. The bear's hoping here the market would convert into a trading range. So they're selling here, betting a breakout will fail. The bulls got follow through. So we retested the breakout point, and we're getting more buying. Bears got trapped, and they're selling out of their shorts. They're buying back their shorts, and bulls are buying to initiate longs, and the market's rallying. So consecutive bull bars, both pretty decent. And this is pretty tight for the bulls. So we need more selling pressure if the bears are going to get anything serious. The bears can try to argue maybe it's a wedge, depending on how you look at it. 1, 2, 3, maybe, or 1, 2, 3. They can argue the bulls are attempting to get a breakout of a channel line, and that's true. And that's a low probability event, but again, there's not enough selling pressure, so any reversal attempt is probably minor. And if we do fall below the June low, there's probably more buyers below. And then for the weekly chart, tomorrow's Friday. We've gone sideways for a couple of weeks. So again, tight bull channel, trend line break, bears hoping for a major trend reversal, but we really just briefly vacuumed down to test the moving average and then continued to rally in these two tight legs. Not a good sell signal here, and then it was bought, and we got another bull breakout. But look where we are compared to the moving average. The traders buying here, are the bulls buying value? No, they're not. The market's expensive, and they can buy here because there's momentum, but that's what they're doing. The bulls are buying momentum, and here, bulls buying momentum far above the moving average. Look what happens when the momentum disappears. Everybody sells. Then we get to value. There's buyers below the micro channel, support to the left. We rally again. We're having the same issue here where the buying is drying up. The momentum is fading. We're getting a couple of sideways weeks far above the average price. So for this week is likely to remain an inside week, inside the prior week. It's a small bar, lots of trading range price action, as you've seen. The expectation, well, we're going to have to probably pull back eventually, fairly soon, to find buyers. We could vacuum down to the moving average again, or we could vacuum down or simply sell off to breakout points. Here's a breakout point. Here's a bad buy signal bar. We could pull back to any of these levels before buyers come back in. But it's looking like the bulls don't want to buy up here. It's becoming more sideways and more two-sided trading. So an inside bar, it's a high one on a smaller time frame. If we trade above the high of the week, there's probably more sellers above. But it's not a good sell signal, and any reversal is probably going to be minor. And then finally, the daily chart. Again, lots of sideways price action. You can see the past 5 days or so. Lots of overlap. And then coming into the day, it's this bar we had yesterday. I don't know. If you watched my last review, you'll remember I mentioned it's a bad high one. So this is the high one signal bar. And we triggered it. But it's not an ideal place to buy. You're in the middle of a tight trading range. And the odds are, the expectation is, there are sellers above yesterday's high and buyers below yesterday's low. And just look at the character of the market. If you looked at the past few days, it's been a lot of sideways price action. And so that's also the expectation going into the day today. markets have inertia, and they tend to keep doing what they have been doing. And with the high and low of yesterday drawn, we will go ahead and start the bar by bar review. Small gap up coming into the day. Lots of trading range price action into the close of the prior day. And now we're rallying on bar one. Bar one's a strong bar. It's a bull trend bar, but the context is bad. Might be two legs up, one, deep pullback, two. But strong enough up on bar one. We have to go a little higher. And at this point, look where we are. Here's yesterday's high. Here's yesterday's low. Most bars are breakout bars, and that applies to the daily chart as well. There are more bars that break out of the prior bar than there are inside bars. What that means is it's likely that today is going to try to break out of the high or the low of yesterday. Right now, looks more likely we're going to test the high of the prior day. So what do you do here? Well, it's not ideal. You can probably buy above bar one for a scalp, betting we'll get to the high of the prior day, above the high of yesterday. But it's really not ideal because it's a second leg up and it's a bull trend bar, but it's at the top of a trading range. And then probably buyers below bar one, bad sell signal bar. And then bar two, we rallied. It's an even bigger trend bar. So consecutive bull bars on the open, both being big and closing near their highs. Is it always in long? Maybe, but again, keep in mind what I said coming into the day and with the overall context. It's possible that it's always in long, but if it's a trading range, it could be a trap. And if it's always in long in a trading range, it's time to look to sell. Remember, buy low, sell high. So consecutive bull bars, that's true, but the context is bad. Bar two is the first bar breaking out above yesterday's high, so the bulls at this point still need follow through. And then bar three, here's our follow through. And how does that feel if you bought the close of bar two? Well, we didn't even trade above bar two, so if a bull bought the close, front running the breakout, they didn't even get a bull breakout. So very bare minimum follow through for the bulls on bar three, and that's disappointing. Bar three is an inside bar and a high one, but the context is bad. Two legs up, one, two, attempting to break out of yesterday's high, which is expected to be resistance. And we're not expecting a successful breakout. So as far as being long here, it can be really dangerous. And the reason for that, there's a couple reasons, but you want to think about, traders are always thinking about the trader's equation. So let's say you're a bull and you bought the close of bar two, stop below one. Your profit target, 1-to-1, measured move is up here, using the bodies. Let's say you're using the bodies of the bars. Here's your profit target. And then look at bar three. If the market's getting here, you need another bar, like bar one or bar two, closing maybe here, halfway. But instead, you're disappointed. And disappointment is the hallmark of trading ranges. And so at this point, we have a high one that's probably high in a trading range. So the odds are there's more sellers above bar three than buyers. Bulls are disappointed. The risk reward is bad and the probability is bad. So no one's going to stay in this trade. So the bulls will exit. The bears know that and they'll sell. And that's why we have sellers above bar three. And we went outside down on bar four. Now, in general, outside bars, well, the reality is outside bars are trading range bars. They're expanding triangles. So usually not ideal to be selling low, selling below an outside bar. But in this context, what we have is a big outside bar closing near its low at the top of a trading range after a failed breakout. So not the worst idea to get out of longs below bar four if you are long. And it's a little bit of an aggressive short because of how strong the bull leg up was. The reality is this will probably get a second leg. And then bar five, we fell fairly far. Bar five is surprising because traders are selling above bar three for a scalp. And then the expectation is bears scalp out, bulls buy a pullback. Maybe they buy the high of bar 1, they buy a 50% pullback of bars 1 and 2, but instead, bar 5 was a major disappointment bar for the bulls. Even though bar 5 has a huge tail on the bottom, this was a big enough breakout. Or, in other words, the breakout went far enough that it should get a second leg. And I learned this from Ali. The distance of the breakout is more important than the close of the breakout bar. So bar 5 closed above its midpoint, but look at the distance from the high of bar 4 to the low of bar 5. It's a fairly big distance. And so think about if you're long on the close of 2 or above 3 for any reason up here, the market comes all the way down here, you're very disappointed. And what you'll try to do is scale in, like buying below bar 1, and look to exit at break even if you get the chance. Bar 5 is a bad buy signal bar. There's probably sellers above bar 5. It's a big enough bar that we may go more sideways. 6 was an inside bar, so even though it's a trend bar, the market is going sideways. It's a trading range on a smaller time frame. 6, a bull bar closing on its high, so what about buying above? Arguing a double bottom? Well, the context is still bad. Think about what just happened. This red line is the high of yesterday. The bulls got a breakout attempt on bar 2. Bars 1 and 2 looked strong, but the follow-through was really terrible. And then we had this huge breakout to the downside. So what's going to happen if we retest up here? There's probably sellers waiting. So even though bar 6 is a good-looking bull bar, the reality is if you're buying here, you're buying just below resistance. Not ideal. And then you can see what happened on 7. The market rallied, tested above the high of yesterday once again, and then sold off. So for the bears, I said this was a big enough breakout, bars 4 and 5, for a second leg. So what about selling below bar 7? It's a low 1 short. Remember, with low ones are good in the early stages of a strong breakout. And this is not that. Just look at the chart and you can see, is the market breaking out in a strong bear trend and you feel urgency to get short? Or, of course not, it's sideways. So what's happening is we have a low 1 short in the middle of a trading range. And the reality is there's probably buyers below bar 7. The market rallied from the low of bar 5 to the high, really, of bar 7. And so on some smaller time frame, this was all a rally from the low of 5 to the high of 7. And the reality is that should get a second leg to the upside. So there's probably buyers below for a second leg. So we triggered the low 1 and found buyers below. Bar 8, a bull reversal bar, but a trading range bar. It's a bad buy signal bar. Some traders might sell above it because it's a high 2 and high in a trading range, really not a good buy signal. But if you think about the bear breakout, we know that this will probably get a second leg, but we're not seeing much selling pressure after. So the bears, they might be waiting for a deeper pullback to sell. Because the market's in a trading range, that's what we're expecting. We're expecting deep pullbacks and delayed second legs. So we have to go higher to find sellers. And remember, bars 1 and 2 were strong enough for a second leg, and we really haven't had it yet. The rally to 7 was enough for a minimum second leg. So if a bull bought the close of 2, scaled in, I don't know, say they bought above bar 6, it's really not ideal to scale in there. But even if they did, you can see where the market tested, and that is the average price of those two entries. That's not what I wanted. My bad. 50. So here's that red line. The market rallied to about there and then found sellers, but probably going to go higher to find sellers. The bear's not interested in selling in the middle of a trading range. That's why they didn't sell below bar 7. And then bar 9. A little bit of a surprising bar. It's a bull trend bar, breaking out of yesterday's high once again, but still within the range of the bars to the left. So what is it really breaking out of? Really just a couple bars to the left, and you can argue above the high of yesterday. But again, look what happened the last time we did that. And isn't it possible that bar 9 might be a wedge? You can argue 1, 2, 3 pushes up. Or you can even just see it as 2 legs. I mean, you can see it either way, but here's maybe 1 leg, deep pullback, 2nd leg, but possible 2nd leg trap. A decent looking bull bar, but at the top of the trading range, and it's a late leg. So really not ideal. And think about the logic. If you bought bar 2, this is what you got, very disappointed. You scale in anywhere lower. If you get bar 9, you see that bar as a gift. The bulls are going to take that and exit their longs. And that might be what the bears were waiting for, to enter short to catch the 2nd leg after this leg. And that's why bar 10, we had sellers. Sellers on the close, sellers above. We tried to break out to a new high and failed. So bar 10, closing on its low, closing near its low, but completely overlapping bar 9. I think it's reasonable for bulls to exit below bar 10. There is a chance that we just sell off here. And bears can short, but the problem I have with this trade, I think it's probably better to wait for follow through. And the reason is we're in a trading range. So big up, big down, big up, big down. Think about what happens in trading ranges. Buy vacuum and everybody sells. Sell vacuum, everybody buys. We have a bull trend bar, everybody sold. A bear trend bar, so what do you expect? Well, the reality is we're probably going to find more buyers. And bar 8 and 9, strong enough for a 2nd leg. But as far as trading that 2nd leg, if you are trading the 2nd leg, looking for a 2nd leg after bar 9, you know it's minor and you cannot scale into that trade. So we got bar 11, a bull bar. Disappointing for the bears. Bears might have sold bar 10 hoping for a breakout below the moving average, but instead bar 11 was disappointing. Disappointment, the hallmark of trading ranges. What do you do with bar 11? Well, it's a high one at the top of a trading range. There's probably more sellers above. But it's bad follow-through for the bears, so they may exit and look to sell higher. And the bulls hoping we get back to the close of bar 9 where they were trapped. $12, we got a bull breakout, but could not close above the bar. Not ideal, and still within the range of bar 10. 12's a low one, short, but consecutive bull bars, probably more buyers below, but not ideal because you're high in a trading range after maybe 3 legs up. I'll keep that drawn. And then 13, we triggered the low one below 12, found buyers below. Look at the bull bars after bar 10. You'll notice they have small bodies and big tails. If you looked at this rally on a smaller time frame chart, yeah, it's 3 consecutive bull bars, but it's a channel on a smaller time frame. There's a lot of overlap in tails, and that's what happens in channels, not in strong spikes. It's also occurring after a bear breakout bar. So even though bar 10 wasn't a bear breakout, we didn't go below bar 9, it is a trend bar. So you have this momentum down and then a channel up. This could be a bear flag. So with bar 13, it's a decent looking bull bar, but the context is really bad. There's probably sellers above. And you have bulls trapped on the close of bar 9. And 10 was strong enough for its own 2nd leg, not to mention this strong enough, it should still get a 2nd leg. So there's probably sellers above for a couple of reasons. 14, another bull reversal bar, but a doji and overlapping all the bars to the left. So the bull channel continues. If you look at a smaller time frame chart, it's really clear. But these are things you start to learn and infer and can see on the 5-minute chart without having to look. But it's always a good exercise to look at the smaller time frame charts and get a good understanding. But what's happening is the market is channeling higher. It's not very strong. There's a lot of pullbacks and overlap. It's not a strong rally. And it's a late leg, maybe 1, 2, 3, maybe 4 legs high in a trading range. Really not ideal. Plus, keep in mind, this line is the high of yesterday. We're expecting a failed breakout above the high of yesterday with sellers above and more of a trading range day today. So we've had a couple legs up. The expectation is a couple legs down. So with that said, probably sellers above 14. And then bar 15. Look at the high of bar 15. You'll notice the close of bar 9 is 55.53 and 3/4, and the high of this bar, the exact same price. We just tested that close to the tick and then reversed down. 15 is a bar that it might be a little early, but for me, if bulls are long, you have to get out below 15 no matter where you bought. It's sort of an always in flip where we've had 2 or 3 legs up, maybe even 4 legs up, attempting to break out of yesterday's high where we're expecting sellers, and the bulls not doing what they need to do. We break out above the high and then find sellers. Break out again, more disappointment. This is just a channel within this entire trading range. The reality is the market's in breakout mode, so we're fairly soon going to get either a bull breakout or bear breakout, and it's probably more likely we go to the downside. Even though all the bars have been above the moving average today, look at the price action and ask yourself, is this above average bullishness? Do I want to buy at a price that's above the average price for what's happening? Probably not. It's really sideways. And the context really supports more to the downside because the bulls tried to break out 2, maybe even 3 times, but failed. And now we have, you can argue this is a head and shoulders, top, left shoulder, head, right shoulder. 16, now at this point for sure, it's an always in flip. 16 is a problem for the bulls. I'm just going to clean up the chart a little bit. I'll keep yesterday's high for now. But 16, you can see, we triggered the sell below 15, and it's a good entry bar. It's not climactic. It's a bear trend bar closing near its low. If you were watching today, you might remember 16. So 15, we tested. Actually, I want to back up because this was also interesting. If you were watching, 15 rallied, tested the bar 9 close, spent a really brief amount of time there, and then sold off and didn't go back. And that's sort of a demonstration of the edge. That's like the best entry price you can get. That's where bears are entering. Like, I like to think of it like that's where Al is entering. And so Al's entering here. It spends a very brief amount of time there, and then it doesn't look back. However, bears are selling there for a scalp. This is not a major trend reversal swing setup yet. So what bar 16 did was sell off to the moving average and then rally, probably above the midpoint of the bar. But then the fact that it closed near its low is a big problem for the bulls. So now at this point, bears might sell below 16, taking a chance. Maybe we've seen the high of the day. We have an opening reversal. The bulls tried. We have a double top, maybe a wedge top. And now we're getting a decent sell signal. And then we had follow-through selling on 17. So now we have a bear breakout with follow-through 16 and 17. 17 crossing the moving average, closing well below it. And the context really supports more to the downside because look where the trading range is. This is high in the range, and there's a lot of bars here. The market found this price to be fair. I'll highlight what I'm talking about. The market, you can see we were in agreement in here. Tight trading range for a lot of bars. The market's likely to come back and test that price somewhere in here, maybe the middle, maybe the low, but somewhere in there. Strong enough breakout, 15 through 17, that the bears likely to get a second leg down. Probably sellers above 17. 18, we have an inside bull bar, but likely just a breakout pullback, not enough to reverse these 3 bear bars. Even though it's a decent looking bull bar, it's completely below the moving average. And you just have to ask yourself, is 18 strong enough to undo all of this? Probably not. Right now we have bulls trapped. Bulls bought below 14, maybe below 11, and 18 did not test those prices. So the bulls are trapped. The bears, they have a breakout strong enough for a second leg. They'll sell any pullback. And then 19 is a problem for the bulls. The bulls did not get a chance to exit on any pullback. 19 is a low one after a strong breakout crossing the moving average with room to the downside. We have room to the bottom of the trading range. So there actually might be sellers below bar 19 and certainly sellers above. And then 20, more selling. It's a bear breakout closing below a lot of bars to the left. All these bars, including bar 6 forward. So the market's moving lower. It's a micro channel since 15 increases the probability of sellers above. We've had a micro channel for 6 bars. So buying above 20 is a terrible stop order trade, which makes it a good limit order trade. And then 21 rallied. It's an inside bar. We did not trigger the stop order buy above 20, but we came close. And what happened was we had traders willing to sell below the high of bar 20. And so there's a sense of urgency. Think about it. If you want to get short in here, and you want to sell a pullback, but you're not getting a pullback, and you're watching the market go on and on without you, at some point, that's where Al teaches, if you feel that sense of urgency, you find yourself waiting for a pullback to get short, it's time to just sell the market. And he talks about the high dive at the pool. And you just plug your nose, close your eyes, and jump. And you just trust that everything's going to be okay. Strong enough selling by the bears, tight bear channel, the first reversal up is likely to fail. So in this context, all you want to be doing is selling or be flat. Inside bull bar, 22. II pattern, the bull hoping it's breakout mode, and then we rally back to the top of the range. Maybe we're testing low in the range. This remains the low of the range. But the problem for the bulls is that the recent average daily range has been about 35 points. And the daily range at this point is about 19 points. And we were expecting sellers above yesterday's high, which we had. And so what are the odds that after this tight bear channel and 2, maybe 3 failed breakout attempts of yesterday's high, that we end up getting the successful bull breakout and double the daily range? It's pretty unlikely. So the odds are this is a pullback in a bear trend. It is a bear trend within a trading range. That is important. But this is still all one leg. And we're probably going to go lower. 23. Bear bar failed to break out below the lows of the prior bars, but 23 is a bad stop order buy signal. Still a tight channel, still a micro channel. We've had how many bars? 9 consecutive bars with highs at or below the prior bar's high. So really increases the chances that there are sellers above. 23 is a bad stop order buy, so good limit order sell. And look what happened on 24. We triggered above 23, good limit order sell, and everybody sold. And 24 is the give up bar. We didn't have much of a pullback here. Breakouts typically pull back, especially in trading ranges. But here's a bear breakout that didn't pull back very much. And then we just kind of trickled down. This right here, you can see it as a 2-bar spike, pullback, and then a channel. And then the market went sideways, and it was breakout mode again. And then we got another bear breakout. This is the bulls giving up. And the bulls will step aside, wait to buy when the market's lower. What are the targets for the bears? Well, there's always several targets. Maybe 16, 17, the breakout bars. You take a measured move of those bars. Here's one target. There's always the leg 1 equals leg 2. That's where 24 went if you used that measurement to the tick. But because this was a micro channel, if you want to look at it that way, all one leg. Here's leg 1. Then there's the pullback. 24 is the start of leg 2. Maybe this is the target. So I'll draw that one in. So there's not too much in the way. Change this color. We'll call it leg 2 measured move. And it makes sense. Look where this level is. You look to the left. I talked about this tight trading range being a magnet where it's an area of agreement. The market broke out away from it in a weak way. 3 rallies with, or 3 buy climaxes with deep pullbacks. The market was likely to pull back and come back down and test here. And this leg 2 measured move is the bottom of that trading range. So, makes sense. 25, more selling, probably going at least a little bit lower. But you do have the argument for the bulls. Maybe this was leg 1, deep pullback. Leg 2, the reality, this is strong enough. We're still probably going at least a little lower with magnets below the bottom of this trading range, the leg 2 measured move, yesterday's low. The fact that the daily range is still, if the recent average is 35 points, we're only at about 23.5. So we could easily fall to the low of yesterday. 25, a bad buy signal, probably sellers above. 26, an inside bull bar, but is 26 going to reverse all of this selling? It's a really tight channel, probably not. Now you can argue it's 2 legs down, low in a trading range, but most traders want to see more buying pressure than that. 26 is a start. It's a bull reversal bar, closing on its high. But I think more bulls will buy below the bar than above. And then 27, it wasn't a very good stop order trade, and what happened was we went outside down, but there were probably limit order bulls buying below, and so the downside was limited. Now we have an outside bar at 27, we've been sideways for 3 bars, and we might be at support. You can see here a bad stop order. Bad stop order signal bar 69. We did test it briefly on 79 yesterday. Maybe we test it again here. And then 28, another bull bar closing on its high. So now we have a second reversal. We triggered the buy above 26 and then went to a new low. And now we're getting a bull bar 28. It's an IOI pattern, which is breakout mode. Possible final flag, might be low in a trading range. With 28 closing on its high, a lot of bears might exit above that bar, and bulls will buy, taking a chance that this is a swing. And so you can take this trade betting, or bulls will take that trade betting it's an always in flip, second reversal, maybe 3 pushes down, 1, 2, 3, and a decent buy signal bar. And then we did trigger the buy on the next bar. 29 triggered the buy. Disappointing, but think about the flip side. Are the bears eager to sell that low 1? Of course not. It's really a small bar in a tight trading range. There's probably buyers below 29. And 30, we tested the low of bar 29 and then found buyers and closed above the bar. So more buying and a bull breakout closing above the prior 2 bars. Probably buyers below and going at least a little bit higher. 31, another bull bar, tight bull channel. Since 27, it's a micro channel. That's 5 consecutive bars with lows at or below the prior bar. That's good for the bulls. It increases the chances that there are buyers below. How many bear trends have micro channels with 4 or 5 consecutive bars without a pullback? How many bear trends have that? The answer is 0. That doesn't happen in bear trends. So the reality is, even though this is a tight bear channel, you just look to the left, we're probably low in a trading range. And this is not ideal for the bears. There's probably buyers below. And then 32, more buying, and we're crossing the moving average just slightly, but the bulls do get a close above the moving average, testing a breakout point here, the 21 low. So we're expecting to bounce here to the downside at a minimum, because any bull who bought here got trapped. But for the bears selling here, hard to buy or hard to sell after this many bars up without a pullback, especially 3 consecutive bull bars like this. And then 33, that's a problem for the bears. You're expecting resistance here, and instead the market goes straight through it. So at some point you have to wonder if This is a small pullback rally at the bottom of a trading range. And now we clearly have a breakout above the moving average. If you look to the left, we have yesterday's high, which is a magnet. We have breakout points like the bar 14 low, basically the high of yesterday. I'll just keep that drawn. What else? The bar 9 low, bulls who bought there got trapped. So there's several magnets above, and this looks more like a trading range than a trend. So we're probably going to test breakout points. Strong enough rally. Is it by the close? It might be. The bars are small. The context isn't great when you look to the left, but it's enough momentum up and enough bars up and a big enough distance that they should get a second leg to the upside. And then 34, it's a doji, so we rallied, pulled back, closed near the low, but it's a trading range bar, probably buyers below, completely above the moving average. We're expecting buyers below the first pullback and a second leg to the upside. And then a bull trend bar, 35, but it's sort of hard to recognize this, but it's a little climactic. Not that it's a huge bar like bar 9 or 2, but just look at the bar ranges. 3 3/4, same, 2.5, 2. It's actually not all that much bigger. But why is it the best? The point I'm getting at is it's the cleanest bull bar since bar 28. Why are we getting the best bull bar after this many bars in the rally? We have a 9-bar micro channel. Most micro channels, once they hit 7 bars, are more likely to pull back than continue. And then you get the best looking bull bar. So more likely bulls will take profits on this bar, especially because look at the prior bar. It's a trading range bar, so you expect sellers above trading ranges. So for a couple of reasons, you're expecting actually more sellers on the close of 35 than buyers. But does that mean you sell 35? Probably not. It's really a minor reversal. And 36, we went sideways. So another trading range bar. Bad sell setup, probably buyers below. Inside bar, 37, going more sideways, but enough momentum up, and now we're going sideways. This might be a pullback before a second leg to the upside. Eventually there will be a pullback, and when there is, it's more likely to be met with more limit order bulls. It's a high 1 on 37, but not very early in the rally, and the context is bad in the middle of a trading range. Inside bar 38, consecutive inside bars, probably sellers above and buyers below, probably going more sideways. 39, we finally pulled back. You can see we tried to break out below three or four bars to the left, and then also below the moving average, and there were limit order bulls waiting. 39 rallied, closed on its high, but it's a trading range bar. Overall sideways for 4 or 5 bars here, probably sellers above. 40 bear reversal bar, but it's not a good sell setup after all this buying pressure. It is a second reversal because we triggered the sell below 38, pulled back, and then a second one on 40. But it's a small signal bar after a tight channel, which should get a second leg, which it hasn't had yet. It's also a small signal bar. Small bar means small risk, and small risk means low probability. And we did not trigger the sell below 40, and instead we had a bull bar. 41 broke out above the bear bar and pulled back. Lots of overlap. This is a tight trading range. The odds are any breakout will fail. It's a limit order market. You have bulls buying below bars and scalping, and bears selling above bars and scalping. 42, a good looking bear bar breaking out below a few bars to the left. But think about what I just said. It's a really tight trading range and a limit order market. And so this is not enough to be selling. And what it might be an expanding triangle, which is just, it's a trading range. So there's probably more support below 42 than traders willing to sell. and then 43, 2-bar reversal. 43 is strong enough. We'll probably go at least a little higher because we're expecting a second leg after this, and we have magnets above that might get tested, but now we have a bull bar high in a trading range. We're not expecting this to just go straight up. And so 44, we have disappointment, which is characteristic of trading ranges. It's a bad sell setup for stop orders. There's probably buyers below, probably going a little higher. And then 45 pulled back. We're in the middle of a tight trading range. Buyers below 44. It tried to break out below and pulled back. Now we have a bad high 1 buy setup. So there might be more sellers above 45. Tight trading range. Sellers above, buyers below. 46, selling off, testing the close of 42. Think about what happened the last time we were here. Do you really want to sell? Even though it's 3 consecutive bear bars, a micro channel, you'd be selling at support, and that's not ideal. There's probably buyers below 46. And then another decent bull bar, 47. Same problem as 43, where it's high in a trading range. Now, we could rally here and test magnets above, leg 1, sideways, leg 2, but the upside is probably limited. This sell-off was strong enough for a second leg. This could all be a pullback before maybe we test higher and then a second leg down. 48 consecutive bull bars, one being big, both closing on their high. Is it buy the close? The problem with buy the close here is the context. You'd be buying high in an area where bulls got trapped. So probably better to wait and see what happens when we test those magnets to the left. We're expecting resistance. And then sure enough, 49 was disappointing. High 1 above 49, but bear bar, high in a trading range. Bad context, bad signal bar, probably sellers above. Inside bar 50, high 1, but it's an inside bar. The market went sideways and still probably more sellers above. And then 51 outside down. Some traders will argue not an ideal shape, but 1, 2, 3 pushes up to test resistance, and then a second reversal. We reversed and triggered the sell below 48, pulled back, and now we have an outside bar, 51, a decent sell signal bar, fairly high in a trading range, expecting a second leg down after this. Endless pullback, but within a trading range. So for me, 51 is another always in flip where bulls have to exit below and swing bears will short below 51. 52, an inside bar, is a pause bar. The market went sideways. It's deciding, but still, bulls have to exit below 51 and bears will sell. 52 is an inside bar, so it reduces the probability for breakouts, but the context supports selling above more than it supports buying below. 53, so think about it. If you did buy below 52 and 53 is your entry bar, that's disappointing. So if a bull did buy below 52, and this is how their entry bar closed, they might just exit the trade. They might bail out, sell their long, and get out on the close of 53. 53, you can call it a high 2, a couple legs down, maybe 3 legs down, but this is high in a trading range. Probably sellers above the bar if we get there. And 54, rallied a little bit, but then sold off and broke out below 53, as well as several other bars to the left, and closed on its low below the moving average. 54 might be sell the close. I think it's confirmed always in short. It's probably always in short below 51, but at this point now we've had a micro channel. The context is good for a big second leg down, which we can draw. Maybe it's like leg 1, leg 2 to here, and it's again near that bottom of the trading range. So again, I'll just draw it like that. And then give up bar 55. So everybody sold below 54. Bears selling to get short, bulls selling to get out of longs. They'd rather buy lower in the trading range. It's possible we stop here. This could be the bottom of the range, but this is enough momentum down. We're probably going lower. Inside bar 56, probably sellers above. It's a bad signal bar. It's basically a trading range bar, an inside bar, and strong enough down for a second leg. Bears will sell the first pullback. Inside bar 57, II pattern, breakout mode. If we get a breakout to the upside, it'll probably reverse down. And same with the downside breakout, but there's an increased chance we go a lot lower before we pull back. And then look what happened on 58. I mentioned on this breakout earlier, it's usually that the distance of the breakout is more important than the close of the bar. So even though this is a weak close, it's similar to this bar even, where if you have limit order bulls buying below, here limit order bulls buying below bar 3 or bar 4, limit bulls below 52 and below the inside pattern. It's all similar what happened on the entry bar, and that's disappointment, and bulls might look to exit. Sellers above 58. We went sideways on 59, but is 59 a good reversal setup? Probably not. Instead, it's a tight enough channel. It's actually a micro channel all the way since bar 51, probably sellers above. 60 going lower. Bear bar closing on its low, but within the range of 58. So the bull's hoping we get maybe 1, 2, 3 legs down to support. Failed breakout below here. And they get a buy signal bar, but this is still too tight. They need to go more sideways. 61, a bull trend bar closing on its high. That's good for the bulls, but it's very similar to 26 over here, where the bulls might not buy that first one. It's a micro double bottom. They could buy it, but more bulls will buy below the bar and wait for more buying pressure and conviction from the bulls. And then we went above bar 61 and reversed down. So what about selling 62? The problem with 62, it's a strong bear bar, but it's a low one at the bottom of a trading range. Look to the left. Look at this support. What happened the last time the market reached this price? We rallied in a small pullback form. So now we have 1, 2, 3 sell climaxes, 2 big legs. You could even say 3 big legs. It's a cluster of support, and that's a problem for the bears here. So low one short below 62, but the reality is there's probably more buyers below. And 63 disappointed the bears. So what about buying above 63? Really not ideal. It's a trading range bar, but for the bears, they needed 63 to be a lot stronger in order to sell a low one at the bottom of a trading range. So they might give up on the trade. So bulls, they might buy the close of 63, knowing that bears will give up. And then we had that bull bar 64. So we had 2 big legs down. You could say 1, 2, 3 big legs down to support low in a trading range. '64 is another always in flip because it's a cluster of support. It's a good buy signal bar. It's a second reversal. Bears will exit above 64, and bulls swing. Bulls will buy above 64. Good buy signal bar. Remember, the market is either in a broad bear channel or a trading range. We are making the lower lows, 1, 2, 3, and lower highs. But bear channel means bull flag, so more likely we get the breakout to the upside. So at this point, bulls will buy here. Maybe they'll hold for the upside breakout, but at a minimum, they're holding for tests of breakout points, like below this bull bar, 47. The market fell straight through it. It was a trading range here. Bulls did something reasonable. They'll scale in lower, look to get here, look to test all the way up here too. I don't want to have too much on the chart. It's distracting. And then a follow-through bar for the bulls. Breakout and follow-through. Not quite getting above the moving average, but in this case, the market's in a trading range. We're above, we're below, we're above, we're below. So when it's below the moving average, you actually want to buy. When it's above, you want to sell. So at this point, breakout and follow through. There's probably buyers below 65, and it might be by the close. 66, another follow-through bar. Lots of overlap, so not ideal. It's a high one, an implied high one on a smaller time frame. There might be buyers above 66, and it's a bad sell setup. Probably buyers below. We have an open gap with these bars. Bears who sold above here are trapped. 66 tried to test the high of 62, but did not quite get there. And then more buying, 67. The bears might be starting to give up. We did stall at the moving average and went sideways, but the bulls are breaking out above it. 4 consecutive bull bars, probably going higher and probably getting a second leg. Outside bar, 68, but it's not a good sell signal bar. It's a trading range bar after it's really a micro channel since 63. The odds are, like happened here, it's buyers below and a second leg up. And then 69 going a little higher. It's a bad buy signal bar above 68. So 69, we might pull back on 70. But 69, strong enough bar. This is a tight enough channel. We're probably going higher. 70, pulling back. We're testing near the bottom of this trading range. And look where we're testing. If a bears who sold below 67 on 68 got trapped on 69. 70 pulled back to that price. What do you think they'll do there? They'll probably exit. That's what happened on 72 or 71. 71 bull bar, but inside bar reduces the probability for breakouts. But do you want to sell below 71? Of course not. There's probably buyers below, probably going higher. 72 consecutive bull bars, not climactic. That's good for the bulls. But 72 is the first bar breaking out of this trading range. They want follow through. Probably going to test higher. You can see where bar 70 tested. I deleted the line, but it's the bottom of this trading range where bears got trapped here. We retested it and we bounced, but now we're going through it. 73 pulling back again. What about selling? 73 is a second reversal. You can even argue it's a third reversal. 1, 2, 3, low 3, but after 2 consecutive bull bars in a tight channel, the odds are there's buyers below and the bulls will get a second leg up. Even though we had spike breaks, we had pullbacks on this chart below 67, below 69. So you can argue it's leg 1, leg 2, leg 3. It's more, if you looked at a higher time frame chart, and by the way, every third bar, let me finish my thought because I'll forget it. If you look at a higher time frame chart, this is just a breakout with consecutive bull bars on a higher time frame. And so what I want to say is every third bar on this chart is labeled. It's multiples of 3, and that corresponds to the 15-minute chart, which is over here. So if you look, here's where we are. So here's 66 is the close of this bull bar, 69 is the close of this bull bar, and then 72 is the close of this bull bar. So it's a micro channel on the 15-minute chart. There's no pullbacks on one time frame higher. So do you really want to sell below 73 when you look at it on this chart? Probably not. And then we had an outside bar, 74, but it's an outside bar after, you can argue, 1, 2, 3 pushes up. So some algorithms will see it as 3 pushes, testing resistance, breakout points to the left. It's an outside bar, expanding triangle, probably sellers above 74. That's what happened on 75. Selling 75 is the same problem as selling 74 or 73. It's these small reversal bars in a tight channel. They're just not likely to hold. What's your target? I don't know, maybe you swing and go for a test of this bad signal bar, but your risk is really small. The signal bar is small. Your probability is low. 76, a trading range bar. Holding above the moving average. We have a spike in channel trend for the bulls. So what we might do is test the start of the channel. What's the start of the channel? Well, it's where the pullback was. So technically on this chart, it would actually be here. Bull spike, here's the pullback, the low of the pullback on 68. That started the channel phase, and then when the market channeled. So spike, pullback, channel, channels evolve into a trading range. They test the start of the channel convert into a trading range, and then the market cycle resets. And so we might test lower, but the downside is probably limited. There's probably buyers below here. And then look where 77 went. 77 is testing exactly the start of that channel. And so, as maybe scary as bar 77 looks, it's really at support, and it's not technically an outside bar, but because the low is below the low of the prior bar and the high is equal to the high of the prior bar, it functions like an outside bar. We had a failed breakout to the upside. We reversed, getting a breakout attempt to the downside, but at support after a tight channel. This might be all leg one, a pullback, and then leg two. So there might be buyers below an outside bar like that. That's what happened on 78. And it's no surprise where 78 rallied to, testing the high of yesterday, testing this swing point as well. 78 to sell the close bar. It might be a leg two trap, leg one, leg two, high in a trading range. Big bull bar, easy to get trapped into buying, but the reality is bulls will take profits on that bar and bears will sell if they're aggressive. Follow through on 79, but really small follow through. Not ideal for the bulls. Probably going to go more sideways. And then more overlap on 80. It's a channel, spike in channel. Probably going to pull back and go more sideways, but basically it's the end of the day. And then inside bear bar, 81, the market closed maybe one tick above the high of the prior day, which was 49, and the close is 49 and a quarter. So that's what happened. For always in today, it's easy to think it's always in long on bars 1 and 2, but when you consider the higher time frame context, you know it's not ideal, and the bulls have to do more. And then when you get bar 3, that's sort of a radar should be going off in your head that there's disappointment and it's not always in long, and that's what happened. We got a very deep pullback. I'm not sure about always in that entire opening range until bar 15 or 16. I think certainly by 16, bulls have to get out below, and bears can sell for a swing. And then the next always in flip was above bar 28. 28, a second reversal at the bottom of a trading range after a nested 2 legs down. Here's leg 1, here's leg 2, and then leg 2 subdivided into 2 smaller legs. You look to the left, and what happened the last time the market was here? We rallied. So always in above 28. And then where do you exit? Well, here's a second reversal, testing breakout points, testing the high of yesterday. I'll redraw that. So 51 came very close and then reversed down. And so probably, I don't know about always in short below 51. Maybe it's a little bit of an early call, but when you get 54, that's when everybody agrees. Bear breakout below the moving average after what happened here. The bulls tried, and they had maybe 1, 2, 3 chances, but they failed. And then the next always in flip is above 64, a second reversal, a strong signal bar, low in a trading range, 3 pushes down. So reasonable to exit shorts above 64 and okay to buy for a swing. Where do you exit that swing trade? I don't know. For me, maybe below 75, you're expecting a test of the channel, but it's advanced management to then look to buy there again, or even pull up a smaller time frame chart and look for a stop order on maybe the 2-minute chart, something like that. That's about it for always in. Stop order trades today. I thought it was reasonable, thinking we'd probably test the high of yesterday, so buying above bar 1 wasn't the craziest thing in the world. And then outside bar 4, also not the craziest trade in the world, but I wasn't expecting bar 5 to do what it did. That was bigger than I expected. And then the next stop order trade that I thought was reasonable was selling below 15. Then you could sell below 16, sell the close 17, low 1, sell below 19, and then stop order buy above 28. And you could buy above any of those bull bars 30, 31, 32, 33, except for 35. I think that at that point, a little climactic and at resistance, probably going to go more sideways. And then stop order sell below 51 doesn't trigger until 53. Sell below 54, sell to close 54, sell as 55 is going down. That's a market order sell. And then the next stop order, buy above 64. I thought 75 was an okay sell, but you have to know the expectation of that trade, and that is a test of the start of the channel, and that's exactly what happened. And then for limit order trades today, bar 3 is an inside bar after you're expecting a failed breakout above the hive yesterday, so you get the bull breakout on 2. Disappointing bar 3, it's a high 1 and an inside bar. Traders will sell above that. Bar 7 is a low 1 in the middle of a trading range, and the bulls should get a second leg up, so traders will buy below 7. 12, a bad low 1, not ideal context because it forces you to buy at the top of a trading range, but if you do, the bulls who buy below 12 are not expecting a bull trend. They're expecting a scalp, and that's what they got. And then above 13 and 14, I thought you could sell, but the ideal entry price was the close of 9 or one tick below the close of 9, where disappointed bulls will exit. Micro channel, strong enough breakout to 17 that the inside bar in 18 is a reasonable bar to sell the close. And you can sell the first pullback, which didn't occur until 24. So that's a limit order sell above 23. A little aggressive, but you could sell above 26, but that's a scalp and you need to exit quickly. And then the micro channel for the bulls, you could buy below any of those bars, but that did not trigger until 39. And then at that point, the bulls did buy below and they scalped out and we're in a tight trading range. Sellers above bars, buyers below. It's interesting what happened here too. I didn't really mention it, but here's a tight trading range. And you have bears selling above where my cursor is, and they get trapped on 48. I'll make it a line. I'll make it a blue line, and that makes it so this blue line becomes support. So bears sell, they're trapped. If we get back here, the market should bounce. We got back there, and the market bounced. That's 2 legs up. 1, pull back, 2. Probably sellers above 50, but I don't think we did, okay. So you could sell above bar 50. And then this micro channel, you could sell the first pullback, which occurred after 61, but that's another scalp. And then you get 62, and you can buy below that bar. It's 3 pushes down. It's a low 1 at the bottom of a channel. Reasonable to buy below. And then you get 64, and you probably scalp out. That's a scalp, but then you can buy again and convert the trade into a swing. Bad sell below 67, buyers below. Same with 69. You can argue same with 73, but it is 3 pushes up. I mentioned the 15-minute chart, so it's really not an ideal sell. So that's why traders did buy below. But then at some point, 75, the market is getting a lot of reversal attempts and overlap. And when we do get that sell-off to test the channel, there's limit order bulls buying that bottom of the channel. And then that's the bounce on 78. And that's about it for limit order trades. And then where do we go tomorrow? It's like I said, basically I'll repeat myself with what I said at the end of yesterday. And that is, just look at the market. Look at the daily chart over here, lots of overlap. It's more and more overlap. You look at the 5-minute chart, it's about as sideways can get. So what am I expecting? I am expecting more of the same, which means sellers above the hive today and buyers below the low of today, and an overall trading range day. There's an increased chance that Friday becomes a trend day and the bulls try to get a bull trend, make the weekly chart. That's to influence the close of the weekly chart. Same with the bears. They hope for a bear trend, but the reality is more likely we're going to go sideways, maybe close in the middle of the weekly chart bar. As always, please feel free to leave questions in the comments and include timestamps for any questions specific to this video. All right. Hope everyone has a good rest of their night. Thank you for watching.